Good morning, students. Let's start with the first chapter of our class 12 syllabus, that is partnership. This consists of three important parts. They are fundamentals, that is profit and loss appropriation account, how to share the profit of the partners, that will be discussed over there. Then we have reconstitution of partnership, which consists of admission, retirement or death. And then we have dissolution of partnership firm, that is the entire business is over. Let's start with the first chapter, that is PL Appro. Before that, these are the different accounts which we have to prepare under fundamentals, reconstitution, dissolution, which we will be learning later. Then we have the first chapter, profit and loss appropriation account. This is the definition of partnership, a relationship between two or more persons who agreed to share the profits and losses of the business, which is carried on by all or any one of them acting for all. The features of partnership: two or more persons, business is done by two or more partners, and it is based on certain agreement. Now when I say based on agreement, then if the agreement is written, then it will be termed as partnership deed. Partnership deed, a written agreement. Written agreement is done to avoid all sorts of discrepancies in the near future. In the absence of partnership deed if absent, then the partners have to follow the Partnership Act and they have to go with these provisions. They are: profits will be distributed equally, no interest on capital, no interest on current account, no salary to partners, or any other appropriation like commission, etc. to the partners will not be given. Will not be given. Loan will be given to the partner if he has provided any money in the form of loan, and that also at the rate of 6% per annum. Per annum word is the most important. Partners will be entitled to rent, because rent will be the charge against profit. Just like interest on loan is a charge against profit, that's why they were entitled to this. Next, profits will be transferred to general reserve, as well as there will be no interest on drawings. Interest on drawings will also be not charged from the partners in the absence of partnership deed. Difference between charge and appropriation of profit, we should know. Charge means whether the company makes profit or loss, charge will be made in spite of profit or loss, and charge comes in profit and loss account, whereas appropriation comes in PL appropriation account, and it is only given if there is profit. If there is no profit, no appropriations. No profit means no appropriation, students. Difference between profit and loss appropriation account. Profit and loss, it starts with our gross profit and prepared just after trading account. It gives us our net profit. Over here we record all the charge against profit. And PL Appro, it starts with net profit, that is it is prepared after PL account, and it contains all the appropriations of profit. After that we get the share of profit, which is again distributed among the partners. Let's see what the different types of sums we see in the first chapter. In the fundamental chapter, we will have these three types of sums: PL Appro, guarantee of profit, and past adjustment. I have separate videos for guarantee of profit and past adjustment. Let's see. Types of questions. On PL Appro, we have the questions which will be divided into two types. Either they will be asking you to prepare some ledger accounts, or they will ask you to make journal entries. Let's see the format. So we have our format for PL appropriation account. Here we have written the net profit in the credit side. We can write by PL account or by net profit. If we have not subtracted this charge against profits, then only we need to subtract. They are interest on loan, rent to partners, and managerial commission. This one. As well as if we have not recorded interest received from the partners for the firm to provide the loan. The firm has provided the loan and interest is received from the partners, and if we have not recorded in PL account, then we need to add this one also, interest on loan to be received from the partners. As well as if we have already subtracted any of these appropriations, interest on capital, salary or commission or interest on current account, whatever, if we have already subtracted from the net profit, from this net profit, if we have already subtracted these appropriations, then we need to add back in order to get the correct net profit. If from this correct net profit, different calculations are required. Like the first calculation, they always give you that charge 10% of correct net profit, transfer 10% of correct net profit to general reserve. The correct net profit is very much important over here. As well as sometimes commission, that also is required to be charged on the correct net profit. We will be giving interest on capital to the partners, we will give salary to the partners, we will give commission to the partners as given in the question. Then we will be distributing the profit among the partners, the share of profit, by writing to capital account, and the profits will be distributed. If there is any interest on drawings, that also needs to be written over here. Drawings, my dear students, are not recorded in PL Appro. Drawings not recorded in PL Appro. Only the interest on drawing is recorded. You will be learning why they are not recorded and everything when I will be explaining you the journal from this chapter. And at last we will be getting the completion of PL Appropriation account. Then we need to prepare capital account if asked in the sum. If they have asked in the sum to prepare capital account and nothing is mentioned, then we prepare the capital account under fluctuating capital method. Otherwise, if they will say fixed capital method, then only we will be preparing capital account under fixed capital method. In fixed capital method, we will have to prepare two accounts, capital account and current account. If the sum is absent, that whether you have to prepare under fixed capital method or fluctuating capital method, then we will just follow fluctuating capital method only. The format is already shown over here, that what we will be writing. Suppose there are two partners and the two partners capital will be written over here. By balance brought down their opening capital. Then the interest on capital, which we have already recorded over there in the PL Appro debit side, that has come over here this side. Then by commission we will be writing over here the commission given to the partners, share of profit given to the partners, salary given to the partner, interest drawings taken by the partner, that also will be recorded over here. Interest on drawings will be recorded over here. Interest on loan, if receivable, then only recorded over here. Interest on loan receivable, this is a very important item, dear students. When I will be doing the individual sums, then only you will understand that how important this item is. And to balance carried down, we will be getting the carried down balance. Instead of writing share of profit, we write over here what? We will be writing over here the capital account. Instead of share of profit, we write over here capital account. We will write over here PL appropriation account, not capital, PL appropriation account. Current account and capital account is prepared under fixed capital method. Fixed capital method, we will have a separate capital account and separate current account. In capital account only we will be writing the capital balances, and if anything withdrawn out of capital, then only record it. And if any additional capital is introduced, then only record it. When we get the balancing figure over here, also balance carried down and the balance brought down. In current account also we have to prepare, we need to record all those items which we have appropriated in the PL appropriation in the current account now. Interest on current account, salary, interest on capital, PL appro, there is the profit to be distributed. Then drawings, interest on current account if charged from the partners, interest on loan if receivable from the partners. These are all coming under current account. And these are the different ledger accounts which we need to prepare. Sometimes we need to prepare partners loan account. When the loan is provided by the partner to the firm, then the loan has been provided by the partner to the firm, then we have this loan account. If the loan is already maintained, then by balance we write. If further loan is provided, then we write by cash. If any interest is charged on the loan, it has to be charged. If not mentioned in the deed, then 6% per annum. As you remember, it will be by interest on loan. Whenever the loan is refunded, that means the firm is returning the money to the partner, then to cash, and the balancing figure we will be writing. Then the total of this loan account will be done. After this, we have partner taken the loan. Sometimes firms have provided the loan to the partner. That means partner has taken the loan. It's an investment in the, it's the investment of the firm. Investment to the partner. That means loan has been provided to the partner. In that case, if the balancing figure is already there as an asset balance, that's why debit balance. If further loan is provided to the partner, then to cash. When the partner is returning back the money, then by cash, by balance carried on. One thing to be noted over here, dear students, is that interest on this loan is not recorded in this loan account. It is transferred to partners. So you see this sum, A, B and C are partners sharing profits in the ratio 2:2:1. For the year ended 31st December 2014, their capital is 20,000, 30,000 and 30,000. That means this is their opening capital. A drew rupees 10,000 on 1/4/15. B drew 10,000 on 31st December 2015, the last date. And C drew 12,000. Students, if the date is not mentioned, we have to consider that it has been drawn in the middle of the year. Partnership deed is there and it provides that interest on capital at the rate 10% per annum. Interest on drawing is 12%, not per annum. Notice, not per annum. That means date factor, time factor is no more there. D was to get salary of 2,000 per month. That means 12 months, it will be 24,000. A was to get commission at the rate 10% on net profit. B was to get commission at the rate 1% on turnover, which is 12 lakhs. Transfer 10% of net profit to general reserve. During the year 2015, the net profit is 2 lakhs before charging any of the above adjustments. It's written that we need to prepare all the necessary accounts. Let's see the accounts. First of all, we have to prepare the PL appropriation account. From the format only it has come. This is the format. The PL appropriation account, first item which we are writing is by profit and loss account. The profit which we have seen was 2 lakhs. We have recorded over there. Then we have the interest on drawings. If you remember, A drew 10,000. 10,000's 12% is 1,200. No time factor because per annum is missing. B drew 10,000. Again 10,000's 12% is 1,200. C drew 12,000. 12% of 12,000 is 1,440. Total interest on drawing 3,880. It was written that transfer to general reserve 10% of the net profit. The net profit was 2 lakhs. From that 10%, so 20,000 to be transferred to general reserve. Then interest on capital. Remember students, interest on capital is always charged on the opening capital. It was written over there 10% per annum. A's capital was 20,000, so on that 2,000. B was 3,000, so on that 3,000. 30,000's 10%, 3,000, and C is also 30%, 30,000's 10% is 3,000. Total interest on capital 8,000. B 24,000 because 2,000 into 12. Commission to A 10% of the net profit, that is 20,000 again. And to B 1% of the turnover. Turnover was 12 lakhs. 1% of 12 lakh is 12,000. Then the residual figure 119,880 is the residual figure of this account. That is the profit which has to be distributed, shared among the partners in the given ratio. The ratio was 2:2:1, which come up to A 47,952, B 47,952, and C 23,976. What we did, 119,880 multiplied by 2 divided by 5 for A and B, and for C 119,880 multiplied by 1 divided by 5, we got 23,976. So this was our PL appropriation account. Now after this we will be preparing the partner's capital account. You notice that balance brought down I have recorded. Interest on capital 2,000, 3,000 and 3,000. The balance, opening balance of capital was 20, 30 and 30, that is recorded. Salary 24,000, commission 20 and 12,000. If you notice, whatever we have recorded in the debit of PL Appro, that is now coming in the credit of PL, in the capital account. By PL Appro, the profits we have recorded. We have to record drawings also, not only interest on drawing, because drawing is reducing the capital. Then we get the balancing figure of capital, the closing balances 78,752, 1,05,752 and 4,353, which is the balancing figure. Next is the second sum. Same sum over here, only two differences I have made. One is there was no partnership deed, and the second, we need to prepare capital account under fixed installment method, under fixed method. Let's see the solution. When no PL, partners, this one is there. When no partners deed is there, then no appropriation. Notice that 2 lakhs, only 20,000 we have transferred to general reserve, and the rest 1,80,000 is divided equally among the partners in 1:1:1 ratio, 1,80,000 divided. After PL Appro, we need to prepare the partner's capital and current account as it is the fixed capital method. So we need to prepare two accounts, one capital account, one current account. Capital account, there is no introduction of further capital, so only the balance which has been brought down we have recorded and nothing else. In current account, whatever comes in PL Appro we have recorded. In PL Appro we have recorded the profit 60,000, 60,000, 60,000 that we have brought down over here. There was no current account balances, so I have given dash, dash, dash. Drawings which will reduce my current account balances now is 10,000, 10,000 and 12,000, and then the balancing figure we have recorded. So here ends our first video of this chapter.